10/19, 2012. What do I mean by that? It's 10 o'clock, 19 minutes after the hour, and it is 2012, and the date is 12/28, 2012. So we are 19 minutes after the hour. It's a major time frame when we are looking at the Apple chart at support level here. And when Apple had a big breakout yesterday, it sold down very hard and it hit the bottom here again right below 505. We can see that ascending breakout. It's very clear. Pull back and breakout. Today we started with the left elbow gap down, testing the support level here, and we went right up to the intraday high. We had the intraday morning pullback, and we've been consolidating. We came right up here and tested where these diamonds are, and that was the resistance level. And we've had a pullback, and each one of these lines that you see are 72 cents per line. And right now it's in the negative delta range in the SMF platform. The IR is 43. What we're going to do is show you by using the MMT platform as far as the equity goes in Apple, but most importantly is how do I trade the $510 weekly call expiration. It is the last week of the calendar year. And they were $6.40 on the close. That's the 510 call. Apple is printing 511.63 by 511.79. We will be wholesale to this entry. The people that bought the calls were 17,812 contracts. $5.30 was the intraday high. $2.60 was the original intraday low, and they bounced, and they are tradable. What we will show you is that we are going to put a live limit order below the market because there's going to be major headlines coming out of the White House at 3 o'clock p.m. Because they do expire today, we are going to put our bid entry on this contract at 85 cents and $1.20. What would have to occur to get that price and that option, because it's a weekly 510 call, and it's slightly in the money, and they expire today. It's the last calendar week of 2012. When you are going to join our live option room, you are going to get these kind of entries right now, just like this live, and you're going to get wholesale. The public owned them at the retail price on the close of $6.40. They're way upside down. And the intraday high was $5.30. So if you own 10 contracts, it would have cost you over $6,000. They're only worth $2,600. Our bids are going to be at 85 cents. If we sell down here, you can see that this is the MMT platform right here, and it's a 3-minute chart here. What we're going to do is take a look at where these intraday lows were on that opening left elbow gap down, and how to trade off the bottoms, and how the intraday movement affects both the 515 put right here that hit a low of 275. It's at 385 by $4. So when the stock goes down, you can make money on this 515 put on a weekly expiration. We teach you both. Both pay money. Right now, based on the fact that Apple's very weak, and the moral to the story is, how do I get that live entry at that next wholesale price? As of right now, we are going to put the price at $1.20 and 85 cents. And we're going to buy 30 contracts at 85 cents. And we'll start the bid right up above there at $1.20. We'll start with 20 contracts at $1.20. And once again, it is volatility. The stock, Apple Computer itself, like I said, is slightly in the money to this $510 call. The $515 put, which is also tradable, and we're going to put live orders to buy this put at $1.80 should this spike up. Because on the opposite side, if we spike up in the name and test the highs, then these puts would come way down in value, right where the pointer is here in the video. And we know that. One thing that we do know clearly, that people can't get these wholesale entries bid and ask. The markets have changed, options have changed. Moving forward in calendar 2013, this is where you're going to want to be. So we got parameters set on both sides of the market. Now, when we take a look at the Apple chart again, it's only in a sideways consolidation move before that volatility hits, and how the high frequency computing cycle models are going to come in here. Right now you can see that it doesn't want to break this line. It's exactly a script from here. It's 1, 2, 3, 4 lines, and each line in our system is 72 cents per line. That's how accurate that is. So when we hit the bottom of this teeny range, we become what we call 2 teenies times 72 cents is $1.44 in the consolidation overall movement. Now, how does that affect getting the wholesale bid? Is that this name has to sell down for this price to go lower. If we're going to get wholesale here on the 515 put, well, then you have to break out higher in order to get this side at the wholesale price. So there are 2 wholesale entries based on directional price volatility. And right now it's 10:25 a.m. Pacific Standard Time, and we're working with our new MMTs and people that are going to be involved in the SMF option pit is how do I buy this at $1.80 based on upside volatility in a name that drops the value here. But then on the flip side of the very same trade, say that this drops back down toward the lows and undercuts the lows in a flash trade, that these would drop down in value and we would get hit on the $510 call at $1.20 and 85 cents. Right now they're not breaking the low because the name isn't breaking lower, and you can clearly see right here that we're mathematically 1 teeny 72 cents, 2 teenies 72 cents more. And when we go up 2 teenies, the values over here and the 515 puts come down. We will show you how to master that wholesale entry. We're market makers in this pit. We're not the retail investor, the stuff that you've always been dished out. So you're always welcome to spend a day with me. You can get these wholesale entries and exits. And I'm going to conclude that it is a weekly options expiration with White House is coming out about the big fiscal cliff, and price volatility pops higher or lower, and then we make our transaction accordingly. So if we start to really break out, we can buy these calls. They're cheap, and then we wouldn't get that lower bid. And as they went up in value, we sold them. We would buy the puts would come down in value, and we would get the lower end of that side. So we're getting on both sides of the market here. So 515 is a wall of resistance. That's why we're using the 515 put. What it takes is to get the wholesale entry here and the wholesale entry here. Right now, these contracts at this calendar time series date at 10:27 a.m. and 12/28/2012, we're slightly 30 minutes almost after the lunch hour in New York, and we can see that these contracts are still undervalued, and 17,000 people are buried in them right now. And we like to buy wholesale below the market. That's what we do best. And we know that that's what you want to do because it's something that you have a very hard time doing. Why? Because you don't understand the high frequency model. Once you understand the high frequency model and spend time with us, you'll know how to get entries just like us because we'll teach you how. And we're trading both sides of the volatility, 515 at resistance with the lower end here at $1.80 entry. We would like to buy these. If these were to sell back down and break the low and they brought this to $1.20 and 85 cents, we would take that entry. Right now, we'll stay within the consolidation of the name. Here is your consolidation right here in this part of the video. This is the SMF MMT equity application, market maker application, and these are the 510 call versus the 515 put. Dropping the bid wholesale here at support and then buying resistance here when this thing slams up. It has a wall of resistance at 515, which is at 515 put strike price, and buying this at $1.80 would give us wholesale entry. 275 was the low. They closed at 625. The high was 630 on the day. And this is the ranges that they have, $3.55 in the put side. And over here on the call side, it only has a $2.70 range on the 510 call. Once again, you're welcome to sign up. We're going to be developing a new page for people that are very serious about weekly options expirations. You get to spend 5 days with me. There'll be a cost to that, but you'll be able to get these limit orders that we're doing. And that means that when these are at wholesale and you make your transaction, you can make a profit and pay for your weekly dues. But you're going to learn, the most important thing is that you already don't know how to trade the weeklies because of the high frequency. They're algorithmic programs that they don't give you. That's the only reason why you don't know. but we're here to show you how it will all work on both strike prices. And this is intraday alert.